Hello, Avila Finance students. Hope everyone had a great Thanksgiving and got a little bit of a break in there. So we only have 2 weeks left. So just make sure to finish strong this last 2 weeks and wrap everything up. This week we will have a forum discussion and the homework problems, and we'll be focusing on Chapter 14, Financial Forecasting, and Chapter 15, Thinking about Working Capital Management. So a little bit of a review of the chapter readings as you go through this week. With financial forecasting, obviously we're concerned about, revenues versus expenses. That goes back to, basic economics. What do we project? If we're a growing company, we're going to hope that sales are going to increase each year. If you're stagnant, that it's unfortunate, and there's also retrenchment that we actually may see sales go down. So hoping that we are a growing company and we're expanding, and just basic inflation too, that prices will go up. We have to invest in some current assets and some fixed assets to keep the growth of the company going. So a lot of Chapter 14 is determining what the financing needs are for the company. And one of the most common methods is a percentage of sales method that says, hey, if I expect sales to go up 10% this year and 10% the next year, basically what you're doing is you're keeping the percentages the same on your income statements and balance sheet to say, okay, if we continue to grow at this rate and we're only keeping so much of what I like to call that soup, the profit left over, what is the additional amount of financing or discretionary financing that I'm going to need to keep the company going? So that's where you're going to look at some of the tables, like Table 14.2 on page 471. Kind of gets to that bottom line of what is the discretionary financing needed. It doesn't say how we're going to go out and raise this capital. It could be short-term, it could be long-term, it could be issuing new stocks, new bonds, but it's important to have a forecast to know where we're going to be so we don't come up short and have a cash crunch, and be cognizant about what the cost of capital is too, especially in this environment now where interest rates are rising a bit. So last thing, kind of wrap up with that chapter, is the idea of a budget. I encourage all of you from a personal finance perspective to do a budget, and corporations do the same thing. So they mirror each other, although it's a little bit different from a personal versus a corporation. They still got to figure out, what their expenses are each month, what the revenues are coming in, and when they're going to have shortfalls or when they're going to have surpluses. Just like in Christmas time of year, it always seems like we have a shortfall of cash when we're trying to make all these expenditures, like paying taxes at the end of the year, buying gifts for individuals. So it may be a down period, and then we have some money come back in if we get a tax refund, say in March. So companies do that same thing, and they forecast out, what are the cash flows going to be each month. When I was at Sprint, worked at the corporation in their cash management department, that's what I would do. I would kind of give reports and projections, and I know certain times of the month that I'd be short in cash, certain times of the month I'd have cash coming in, and then I'd try to figure out a way to finance it through the short term at least. And that kind of transitions over to our next chapter, the 15, is the working capital management. And we're working capital management, again, think about that current assets minus current liabilities. I need to have inventories on hand. I need to have things to make payroll, so you're going to need to have some liquidity to get through those months. And there's two ways we can approach this. We can approach it from a relaxed strategy. That is, I can borrow a lot of long-term money, so I'm not having to come up with payments every single month of something due. Or I can keep it very short-term and take advantage of lower interest rates. But as I mentioned, as interest rates have been going up, it's becoming more costly to borrow short term. So executives or those in finance that make those decisions may decide to, hey, let's, instead of issuing commercial paper every day, let's go out and issue a bond so we're not pressured to have to come up with this money every month. Same thing again, I think I mentioned this in the class before. Should I take out a 15-year mortgage versus a 30-year mortgage? Well, 15-year mortgage, you're going to save a lot more money, but it also means your monthly payment is going to be a lot more each month. So corporations have to make those same decisions too. All right. Last thing just kind of talk about is the cash conversion cycle and some different ways to raise short-term cash. Cash conversion cycle, we look at the days sales of accounts receivable outstanding, the days sales of inventory minus the days of accounts payable. So ideally, the most efficient companies are going to really reduce that cash conversion cycle Some companies like Intel or Harley Davidson work on just-in-time inventory systems because they don't want to tie up a lot of money in cash, and cash is an opportunity cost and cash is an expense. So obviously the longer it's taking for our customers to pay us, or the longer that time is sitting on shelf for an item or a product, that's money tied up that's not earning anything. So we want to try to reduce that as much as possible. I mean, Walmart has very elaborate models about their inventory and just keeping the right products on the shelf and making sure they zip through as fast as possible. But a car dealership is going to have a much different inventory structure, and they're not going to be turning over cars every day. So it's going to depend on the nature of your business too. But again, thinking about some of those sources of short-term credit, one that the textbook mentioned is just the trade discounts. Also the huge opportunity cost if you don't take advantage of a trade discount. Sometimes with paying a vendor, they might offer you two net 30 or something like that. That if as long as you pay within 30 days, I'll give you a 2% discount. And not taking advantage of that, paid in the timely time period on an annualized basis, can be very costly. But some other examples, as I mentioned, the commercial paper could be an example. It could be, just bank loans. It could be also establishing lines of credit with a bank. Lines of credit is just the hopes that you don't have to borrow against it, but it's there and available if you need it. So you're going to read more about these short-term financing methods to help companies get through, just the daily operations and the monthly operations get through the year. So, well, that's it for this week. Keep it a little bit more brief, but if you do have any questions, send me an email. But try to get that first forum post in there by Wednesday before midnight, and make sure to respond to your peers, and I'll jump online and talk to you there. So take care.